In today's training, I'm going to walk you through 5 critical numbers every single investor really needs to be checking, because these 5 numbers control how fast you reach financial independence. And without those 5 numbers, and if you don't know these 5 numbers, you're essentially guessing your way through to your financial goals, and that's never a good thing. You want to be very intentional, and you really want to make sure you get to your financial goals. And again, these are key metrics, but obviously there's more. But we're going to start with those metrics in this training. Now, before I walk you through those 5 metrics, I want to give you a visualization. I want you to think about these 3 scenarios I'm going to walk you through here. And really think through as we go through this here. In scenario number 1, let's just say for a second that you're dropped in the middle of nowhere with a car. And this car runs, but there's no dashboard. None whatsoever. Just imagine that for a second. And you have no idea about critical information such as fuel level, speed, or engine status. You have no clue how fast you could be driving or what's going on with gas. There's also no GPS available. And your only task is to reach your destination, and you know that once you run out of gas, it's the end. Now, how would you feel about that? I want you to just visualize that for a second. And you can feel that uncomfortable situation. This is how most investors are actually driving to their journey. They have no dashboard, no idea of what they're doing. Okay. Now, let's take the scenario to the second step here. Now, let's assume for now you have a dashboard in your car, which gives you a sense of relief, providing essential information like fuel level, speed, and engine status. How would you feel? Obviously, you would feel much better. But is there something missing still? Okay, think about that for a second. Now, in scenario 3, let's just say now you're given access to a GPS system, and you're also given a specific destination to input into your GPS system. Boop, 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 boop. And now you have a car with a dashboard, and you have exact directions. How would that feel? So what I want you to really think about is reflect on how this really relates to your own financial journey. Because most investors have no clue what the dashboard looks like. They have no clue about how to get to that destination. They have no GPS system, essentially. And this is critical for your success, because you cannot afford to bounce all over the place for decades and decades, just bouncing all over the place. You want to be very intentional. And so with that, let's go ahead and dive into those 5 metrics. And I want you to realize, as we start building this dashboard for you, and essentially the speedometer here, you'll see in a second, you'll start seeing how much better you're going to feel. Okay. And all I'm going to ask you to do is just track these on a regular basis. Let's talk about the 5 metrics every investor needs to know. Now, these are going to eliminate opinions and start giving you very data-driven, help you make data-driven decisions. They're going to expose bottlenecks that you really need to know, and you cannot afford to find out 10 years later that there's been something off. And they shift you to a wealth creator thinking. The way you think isn't about one specific asset or the return over here. You have to be looking at the whole system. This whole system is your vehicle, folks. Okay. And so you have to be thinking about the whole system. And that's what wealth creators do. So with that, let's go ahead and dive into the first metric here, which is total assets. And I'm going to give you a little bit more information about how to be thinking about this. So the first metric is total assets. Now, why is this important? When you focus on increasing total assets early on in your investing, this really helps you get to a point where you have enough volume of assets and cash flow to be able to make a dent. Because returns, a lot of investors are focused on returns early on. Returns don't make a dent early on when you don't have enough capital. Okay. And so the key is you want to accelerate your wealth, and you want to get to a certain total assets, and you need to know what that total assets is. But that gives you enough momentum to be able to start making a difference. So when you get a good return on a big number, you start seeing a result. So wealth accelerates when total assets grow early on. And so your focus, depending on where you're at in your journey, your initial focus right now is to grow your total assets. Very, very important. Returns matter later and capacity matters first is what we're talking about here. The next metric is net worth. So as you're increasing your total assets, you have to be thinking about your net worth. Your net worth should be increasing as well. And so net worth tells you where you're at. So imagine, so it doesn't tell you how fast you're going. It doesn't tell you certain key information, but think of it as a scoreboard. Okay, you have this score, and total your net worth is this much, and you're trying to get to this much. Okay, so it doesn't tell you how fast you're moving or if you're about to crash, but what it does tell you is at this point in time, here's where I'm at. So this is something you're going to keep increasing. Very important. Which really leads me to the next one. One of the most important things you need to measure is your change in net worth over time. This is essentially velocity. I'm going to explain why. So think of this. This is the growth rate of the system. This is essentially your velocity, how fast you're moving towards your goals. And this number, I'm going to give you the equation here in a second, needs to be at least 10% early on, at least 10% increase every year in net worth. And I'll tell you, for a lot of our members, we're trying to get them to 20, 30, 40% per year early on. This is critical because you want to get to the point where you have enough assets, and then you're going to have those assets essentially move you towards, pay down debt or anything like that. So it's so important early on to focus on increasing your net worth and being very careful, which we'll talk about here in a minute. So this is the growth rate of the system. This is not investment return. This is net worth velocity. Okay, this is one of the most important metrics you can track. And you need the other two to really increase that. So I'm going to give you an example here how to do the math. So you're going to look at your net worth from the previous year and your net worth from the most recent year. And then what you're going to do is you're going to plug them into this equation here. So here's how this works. Again, this is the speed at which you're moving. You're going to take 468,000 in this example, which is the most recent year, minus the previous year, 400,000 in this example, divide by 400,000. Now, this number, this speed, you want to really track once a year. Now, you can track it more often if you choose to, but you're going to be looking at those 5 metrics once a quarter early on, and then once a year later on in your journey. But here's what happens. This number, you want to be looking at every last 12 months. So every quarter, you're going to look at 12 months back, 12 months back, 12 months back, because you want to make sure that there's a trend. And again, your goal is to make sure that this is no less than 10%. Higher the better, okay? Now, without doing crazy stuff, which we'll talk about in a second. So how much of that, the second part is how much of that increase in net worth came from your hard work and how much came from your money working for you. So obviously you want more your money working for you. So when you look at the increase in net worth, ask yourself, is this my money working for me? If 80% of that came from my money working for me versus the 20% of hard work, that's really good. So the more over time, what you want is your money working for you and increasing your net worth. You want to get to a point where you are increasing your net worth significantly faster and early on. And then later on, you're going to taper off and it's going to slow down because by then you've reached your financial goals and then you're going to shift into a different phase of your journey. Right now, we're focused on your early on, what we call the grow capital phase, which is the first phase everyone should be in. Most people are in, I should say. So critical metric. So if you look at the 3 we have right now, total assets, if you do the right job, right, will really help you. Again, as you're increasing your total assets, will help you increase your net worth, and you can track the difference with this here. Okay. Next one is debt to asset ratio. And again, I have to stress this, that there are a number of key ratios, but we're giving you the very important 5. The debt to asset ratio is essentially what percentage of your assets are debt. So you're going to take debt, divide by assets. All your debts, credit cards, mortgages, everything, divide by all your assets, including, properties or cash or stocks, whatever they are. What you want is you want to make sure you control that, because early on, when you manage this correctly, this helps you increase your net worth pretty fast. It has to be controlled debt. Here's what I mean by that. Let's go back to your increase in net worth. We said is your velocity. It's equivalent to your speedometer. But the debt to asset ratio done correctly is the equivalent of the gas pedal. So when you are pressing down on the gas pedal in the car and you are looking at the speedometer is a result of you pressing down on the gas pedal. Same thing here. The increase in net worth is a result of you pressing on the gas pedal, which is the debt to asset ratio. Again, that's just one of the key metrics, okay? And the key here is you're not going to go out crazy and start buying stuff with debt. You want to know how to control it, how to measure that. Very, very important. And the last one here is portfolio liquidity ratio. This is, I would say, one of the most important parts of these five. And the reason is because this gives you breathing room. And I'm going to give you those numbers, what these should be. So illiquid wealth looks impressive until you actually need to move. So what does that mean? I have seen a lot of people come and talk to me about how much they have in, say, real estate, or they have in whatever. But what happens is, once something happens, once the market moves or shifts, I've seen people lose a lot of their assets because they had no liquidity. And that's what I mean by you need to move. Many times, and this is part of your journey, it's a natural thing. You need to be able to move things around, and you need to be able to shift, because the market you cannot control. The market is a signal you have no control over, but you have control over what you do on your side. So think of a car. When you're driving a car, you have no control over the outside world. When you see something on the freeway, you have no control over that. But what you have control is how you react and how you shift and how you brake. Portfolio liquidity ratio, which should be 20% or more, it gives you the ability to move the car. It allows you to shift, to brake, to turn, to switch, to all that stuff. That is what I mean by you need to move. So portfolio liquidity ratio is a key part of you growing, because as you're growing your assets, you need to have liquidity. And again, like I said, that should be roughly 20% of your whole portfolio. Now, what does that mean? It just simply means you take all your assets, and add up how much of that is liquid. And when I say liquid is how fast can you turn it into cash without selling things at a discount. And that should be roughly 20%. And I'm not talking about cash here. Okay, there's a big difference here. Could be ETFs. It could be certain stocks. It could be certain things like this. Now, again, I don't like to count stocks as something very liquid, because depending on where they are, but I like to have stable ETFs that I can sell in case something happens, but it gives me that flexibility to be able to move very fast. And again, that should be 10% or so. In the beginning, for most people, I know that a lot of people have no liquidity. You really want to start building that up, maybe 10%, 15%, and then eventually get to 20% liquidity ratio. Now, by the way, this includes your reserves, just for the record. So if you have emergency fund, reserves, safety buffer, all of that is part of your portfolio liquidity ratio. So these 5 metrics are critical. And if you think about them, is the portfolio liquidity really helps you cover the downside, right? Debt to asset is the gas pedal, right? So you're going to be able to control how much you go, how fast you go. The result is the speedometer up here, increase in net worth. You'll start seeing this going up, and you're focusing on acquiring assets. So your total assets are going up, as opposed to you paying down mortgages or paying down debt early on. That's actually going to backfire. So what you're doing is, that's why we don't just look at net worth, we look at total assets. Because some people start paying down their mortgage and they say, my net worth is going up. Yeah, your net worth is going up, but your total assets is what you need to increase both of them early on. Because someone with net worth of 200,000, with only 200,000 worth of assets, it's not going to make a dent in your, you're not going to be able to retire on that. What you want is you want $4 or $5 million, $3 million, whatever it is you need to be able to retire, and then use those assets to pay down and manage your portfolio and pay down the debt eventually, what's called deleverage. That's why you have to build something very structured. And again, I'm not a financial advisor here. I want you guys to be talking to your financial advisors about this. But these are the 5 key metrics I would start with. With that, let's move on here. When you know these 5 key metrics, investing stops being emotional and starts being mechanical. All this noise about wealth building starts disappearing, because now you are in control of your wealth. And now you start making better decisions. You can track everything and see, am I moving forward or not? Because if your net worth is not increasing at least 10% per year early on, that means the strategies you're implementing are not working for you. And so ask yourself, are they moving me in the right direction? And by looking at those numbers, you can start saying, you know what? They're not moving me in the right direction. Now you can make a firm decision. It's not emotional anymore. It is a decision based on data. Now you can say, you know what do I need to do to increase this very strategically? And here's what I'm going to say. And the moment investing becomes mechanical, speed shows up. What do I mean by that? All the emotions around what should I do, all the noise, all goes away. Because now you are making decisions based on data. Now, here's one thing I found out about a lot of investors. They're not willing to face reality that they're not moving fast enough, because our runway is getting shorter every single day. And without those 5 metrics, okay, you are essentially guessing your way to your hopefully to your goals, right? So you really need to start tracking those numbers and try to track them again, like I said, every quarter, every 3 months, and then look back at your whole last 12 months and ask yourself, am I moving forward? Okay, very, very powerful. And here's my promise to you. Do this and start seeing how you feel so much in control, and be accountable to yourself. Okay, be accountable to yourself. So with that, hopefully you enjoyed this, and we always have links right below this video for fun stuff we have or different resources. Click on them, check out the notes right below this, and I'll see you soon. Take care.